The U.S. economy is in a tsunami, a perfect storm. A number of forces are coming to play. For one thing, over the last several years, our prosperity has been driven by borrowing. We have a huge trade deficit. We've imported more than we've exported, and we borrow from the rest of the world to pay for that. The way that money gets into the hands of consumers is by foreign governments buying U.S. bonds. That in turn makes long-term rates lower, and the banks took that money, essentially, along with money in pension funds and mutual funds of various kinds, money market funds, and essentially sold us mortgages. Over time, we had to become involved in risky mortgages. Essentially, people borrowed beyond their means, and the prosperity ran out. The banks took the mortgages they wrote and bundled them into bonds and sold them to these investors. In time, they got stuck with some of their own bonds. And these bonds were backed by very poor mortgages. When they didn't pay out, when they started to default, the value of those securities fell and the balance sheets of the banks were seriously eroded. The bailout, essentially, provides the banks with liquidity in various forms. The federal government is going to buy some of those bonds from them and work out the loans. And it's also going to put equity into the banks. It'll probably be about it will likely be $250 billion in additional equity and at least $450 billion in buying loans off the books of the banks, or mortgage-backed securities off the books of the banks. So this will give the banks more capital and more liquidity. It'll help them clean up their balance sheets. It won't completely clean them up, but it'll help a lot. It's putting the most money into the largest money center banks, mostly based in New York. These banks, unfortunately, are part of large financial supermarkets today. They're involved in investment banking, derivatives trading, carbon trading, foreign exchange conversion, all manner of financial products. And a lot of these banks really aren't much interested in making loans anymore because they find these other activities much more profitable. If you go back 20 years, commercial bankers, the guys that made you a loan, got repaid, made a decent salary, but they didn't make the kind of money these financial engineers do, that do M&As and things of that nature. Now, because they're in the same financial houses, they expect to make that kind of money. And if they can't, they're not interested. As a consequence, as the federal government has given Citigroup and others cash, they've taken that money and they're really exploring other activities. So you have a situation where, for example, Citigroup hired the M&A director from the recently collapsed Lehman Brothers because they plan on emphasizing global merger and acquisition activities, among other things. So it isn't at all clear that the banks are going to turn around and use the money we have given them to make loans. And that's really a shame, because one of the reasons we're giving them all these loans is we need the vital services banks provide. Sooner or later, if the bankers' strike doesn't stop, what we're going to see is the federal government becoming more intensely regulating these banks, essentially getting involved and defining their lines of business for them. Sooner or later, the banks will have to start making loans, or the federal government will have to reach into their everyday activities and compel them to do so. It is absolutely ludicrous that we're giving the largest banks $250 billion in equity and taking bad loans off their books and not requiring in return that they behave as banks. After all, the reason we're helping them do these things, the reason we're helping the banks out is because we need them to make loans. The major problem in New York today is the compensation structures of the bankers. They receive large bonuses and incomes based on fees from turning securities. The deal to provide them with equity had little impact on that compensation structure. It did restrict golden parachutes for the top five executives in each bank, but in an operation the size of Merrill Lynch or Citigroup, that doesn't mean very much at all. Until we change the compensation structures and impose more specific requirements on the banks in terms of their conduct, we shouldn't expect them to be making a lot of loans anytime soon. The problem is the New York banks are not providing the conduit between the 8,000 regional banks and that large pool of money. Eventually, someone will bridge that. The reason the economy is tanking is it's going to take time to build new institutions to create that bridge. So yes, we'll be able to borrow money again in the future. However, we can't continue to have a prosperity that's based on borrowing against weaker and weaker forms of security. In order to keep the economy going, we were borrowing or increasing our borrowing more rapidly than our ability to repay would warrant. That's why we went from 10% down on mortgages to 5% down to 0% down to 0% down in borrowing our closing costs to mortgages that permitted our principals to rise over 5 years under the supposition that we could refinance the mortgage in 5 years, these adjustable rate balloon loans and so forth, these very complicated engineered products which essentially bet that housing prices would go up and go up and go up. You can't run the economy on that kind of Ponzi scheme.